Imagine standing in a high-rise office overlooking Manhattan long after the trading floors have gone quiet. On the screen is a single proposition: take $5,000 today or wait for $10,000 in 5 years. At first glance, this appears to be a basic math problem about accumulating wealth. Most people look at these numbers and see a simple calculation of interest. However, choosing between these numbers requires you to place a specific price on 5 years of waiting and the uncertainty of that period. By quantifying that trade-off, finance becomes the mathematical art of deciding exactly what future potential is worth today. This logic dictates how different people structure their lives. One person might spend their income to enjoy resources immediately, while another delays gratification to build freedom later. Despite their different lifestyles, both individuals are balancing the same equation, weighing the value of present consumption against the expected value of future cash flows. A flaw exists in this calculation. The value of any asset, whether a stock or a career, relies on a future that remains unknowable. The core challenge of investing involves finding a reliable way to price that uncertainty in the present moment. The financial market functions as an advanced data processing engine, moving billions of dollars without the need for shouting or chaos. This engine constantly solves for a single variable. Given a specific amount of risk, what is the mathematically fair return? To calculate that return, the market divides all financial risk into 2 categories. The first category is avoidable risk. These are isolated failures, like poor corporate management or a single bad executive decision. These risks can be eliminated. The second category is systematic risk. This represents structural economic forces, like recessions, inflation, or geopolitical conflict. This risk remains anchored because no single investor can escape it. A rational market treats these 2 categories differently, and this distinction dictates the pricing of every asset in the world. Investors often make the mistake of betting their entire future on a single sure thing. This exposes their capital to high levels of avoidable risk. Portfolio theory addresses this by combining assets like stocks, bonds, and real estate. Because these assets react to market events in different ways, their movements often oppose one another. Stacking these different behaviors together cancels out the isolated failures of individual assets. The resulting trendline moves with much greater stability. Diversification functions as a mathematical shield, filtering out the specific risks within an investor's control. When an investor uses diversification to strip away avoidable noise, they are left holding only the inescapable systematic risk. This chart shows the capital asset pricing model. It illustrates the formal link between systematic risk and the returns an investor can expect to receive. This leads to a central rule of the market. Investors receive compensation for absorbing the systematic risk they cannot avoid, rather than the gambles they choose to take. If the mathematical architecture of the market is this precise, we have to ask why highly intelligent people still lose everything. One reason is leverage. Borrowing money to invest acts as a multiplier. It increases potential gains, but it also increases the probability of structural collapse. A second reason involves psychology. The traps of panic, greed, and herd mentality can override even the most logical financial plan. The psychological instability of the person holding a portfolio often poses a larger threat than the market itself. Returning to our original choice, the $5,000 or the $10,000, the correct answer depends on balancing that market volatility with your own emotional control. Understanding these mechanics provides a benefit beyond the mere accumulation of wealth. Finance is the study of decision-making under scarcity. Its true power is the acquisition of optionality, the ability to keep your choices open